All right, good evening, ladies and gentlemen. Welcome back to episode 15 now of the Australian Gold Weekly Review. Thank you so much for tuning in all these weeks. We can't believe this is week 15 that we are shooting for the Australian Gold Weekly Review. And while there was a slight dip in our viewership and engagement initially, we managed to pull it back to quite a good extent. And in fact, we've been doing better than ever in terms of viewership, in terms of engagement, in terms of feedback, comments, everything. So thank you so very much for your engagement, and we hope this engagement continues and you continue to share this series with everyone who you think may need it and more. So thank you very much once again. And joining us today is our managing partner and founder at Gold of Australia, Mr. Brian Chu. How are you, Mr. Brian?
I'm good, Ved, and it's spring over here down in the Southern Highlands. Hopefully the hay fever won't get the better of me. I'm got a bit overwhelmed by the pollen, so you might see me with a tissue or two every so often, but I'll definitely silence myself if I sneeze or make snivelly noises.
I think our viewers would be absolutely fine with that. No complaints whatsoever at all. And yes, as far as this week is concerned, as usual, we'll be covering moves in gold, silver, oil, the ASX All Ordinaries Gold Index, followed by a members section where we cover moves in Kingsgate Consolidated, whose share price has been up 11% this week after they released their quarterly report on the 30th of October. So something to look forward for you in those terms, as well as a few speculative gold stocks that have corrected significantly in the short term and have become a fair valuation buy through the eyes of Mr. Brian at the moment. So he will be covering that too. And please note that none of the content that we discuss in this video qualifies as financial advice. So if you're on the outlook for financial advice, we recommend that you seek a licensed expert. And if you want to continue watching for the members section of this video, we recommend that you go to the Gold Hub Australia website. The link is in the description below, and sign up for our membership for free, which will enable you to watch both the members only section as well as the preview section for this video. So without any further ado, let's get started. Starting off with gold, remained relatively flat this week. It's down to $4,004 an ounce as compared to $4,008 an ounce last week. So not a very significant movement, or not a very spectacular movement for gold this week. However, it did go down quite a lot during the week, and it tested the $3,900 per ounce range on Wednesday and Tuesday. After which it pulled back up to $4,004 per ounce as a result of US real yields dropping and the market indices in the US seeing a downturn after Wednesday. And I think we've got, this has got to do with Michael Berry. I'm just speculating, but 5 days ago, there's news that's come out that Michael Berry, who is managing Sion Capital in the US at the moment, has betted $1 billion against Nvidia and Palantir, as a result of which these two AI-based stocks went down by 10% during the week, with billions and billions of dollars being wiped out of these two companies alone, which negatively affected the market indices in the US, and hence people rushed into gold seeking safe haven. Now note that Michael Berry is someone who correctly predicted the 2008 financial crisis way before it happened and managed to book a lot of profits as a result of that. By which we do not mean to say that he might be true this time round. Everyone obviously has to do their own due diligence, but we have a feeling that billions of dollars being wiped out of only two AI stocks this week has got to do with gold's rise to $4,000 and fighting in the $4,000 region, as opposed to the $3,900 region, which it was doing just on Tuesday or Wednesday. So what's your take on this, Mr. Brian, especially considering the fact that the US government shutdown is now in its 37th or 38th day maybe, and the expectations of a rate cut in December are 67% at the moment?
Well, I wasn't actually too aware of the Michael Berry short on tech stocks until you mentioned it. I did notice that the tech indices, the Nasdaq index actually came down quite a bit this week. And I have also noticed that gold seemed to have found itself a base and it seems to be trying to break out of 4,000, and at least it's not going down below 3,900, which we had thought was possible. Now, are we completely is that coast completely clear just because we saw gold basically hover around $4,000 an ounce? We can't be sure yet. I also note that the US dollar index is actually also creeping up, and it's at over 99 points now. We haven't seen it trade above 100 for several months now. And this is despite the US government shutdown. So the irony is that even though, technically speaking, the US government shutdown is supposed to reveal the weakness of the administration, perhaps we could say not just the Trump administration, but as in the state of the country in its cohesion, people are still actually valuing the US dollar over the alternative key currencies such as the euro, the yen, the pound, etc. So that's interesting. Gold and the US dollar index are actually moving up once again, but only slightly. We can't be sure. So let's see how the rest of November goes and the extent to which the US government shutdown either continues or whether there could be an agreement reached over certain things regarding the Affordable Health Care Act or Obamacare, what they say, what they call it, as well as also the Trump administration wanting to bring about the One Big Beautiful Bill to try to spur the US economy back into action and also cut out bureaucracy and waste within the US government and the various agencies.
Yeah, and to add to that, given the government shutdown, we as investors have to rely on private economic data in order to make our decisions in terms of investing in gold and other asset classes. And as a result of that, the private report related to jobs data this week came out on Wednesday, I believe, and we've seen the highest jobless count this month in October, ever since the longest time, I believe. This is the largest jobless claims report that we've seen in months, if not years. So what is your take on that? How can that fuel expectations of a rate cut or not fuel them? And what has it got to do with gold?
It's interesting you bring this up about the jobless data seeing a large jump in the numbers. Keep in mind that part of this may be as a result of the government shutdown and laying off of a lot of government workers. Personal opinion here, I certainly hope that the jobs that were cut are all the DEI jobs, all the bureaucratic jobs where it's not about productivity, but it's about posturing, moral virtue signaling, as well as just creating positions where it's certain people trying to impose some odd fringe value on the rest of society and wasting government resources and all that. So if that is the case, then the jobless or the cut in the job numbers may not actually be a bad thing to the US economy. And I also hope that if that is the case, that could spread to the rest of the Western society, because we certainly can see productivity improve if we are actually getting the right types of people on the jobs, and certain jobs where it's not needed, it's just removed and we don't waste capital. Going back to the economy and also the potential for the Federal Reserve rate cuts, I certainly think that short-term talks on rate cut expectations is probably meaningless, because the Federal Reserve has as much of an idea of how to run an economy, maybe less of an idea of how to do that than you and I, and also most of our viewers here, because I think central planning is a terrible idea. And with central planning, what we have seen is the free market is looking towards a bunch of people sitting around a table to make decisions on whether to buy or sell or to conduct business activity. The sooner that the markets can actually leave or get off the reliance on liquidity, then hopefully that might actually help business growth return. But that's ideal. It's idealistic. For quite a long while, I think we have to expect that the markets are going to continue to march in the tune of the daily musings of a bunch of economists who call themselves central bankers, who have the levers on the liquidity, and therefore the rest of the market.
All right, thank you so much for that, Mr. Brian. Now, moving on to silver. Silver fell by 0.45% to $48.36 an ounce. So it's been following suit with gold for the past 2 weeks, which it wasn't as an exception 3 weeks ago when industrial demand was priced in to the silver metal after supply expectations dropping, especially in the Asian regions. Oil, however, decreased by 1.66% to US dollars 59.79 per barrel. And the story is the same for this week as well. There's growing concerns around supply and demand. However, OPEC Plus group has indicated that it will pause additional output rises early next year, which is a move that markets interpret as acknowledgement of slackening demand or a supply gut. So as a result of that, I don't think we can expect to see oil prices increase, especially considering that this limitation of supply overflow is in response to reducing demand. What's your take on that, Mr. Brian? What are the implications for that on the gold-oil ratio, and how can we see the margins of gold producers improve, stay flat, or decrease in the quarters to come?
Yeah, so I was surprised to see that the price of oil has gone back down below or just around 60 US dollars a barrel. It did actually rise above it for some time, and the gold to oil ratio fell from about 75 in early or mid-October to around 66, 67. Still remains very, very healthy. The weakness of, or at least the perceived weakness or uncertainty over the global economy is continuing to weigh in on industrial metals, including also silver, which is behaving partly like an industrial metal and also partly like a precious metal. As we've seen, silver has actually come back up to about 48 US dollars an ounce, which is quite positive. I still am cautious about where the base could be, where we might find a base for gold and silver in this correction. Maybe I could be wrong about the 3,800 US dollar gold and the 42 US dollar for silver. If that is the case, we are actually seeing some value emerge from some of these gold stocks, thanks to the gold to oil ratio remaining strong, and also oil remaining weighed down over number one, higher supply. I think the US is continuing to push for higher oil and gas production, as well as also offset by lower demand, possibly in certain parts of the world because of economic uncertainty. But gold stocks themselves, I am not waiting to find the base to buy in some of these value gold stocks, because there is actually we have identified quite a number of companies that where the value is emerging once again.
Right. Thank you so much for that, Mr. Brian. And now, as you talk about value, let's talk about the ASX All Ordinaries Gold Index. So yet another flat week for the ASX All Ordinaries Gold Index, at least if you look at it on paper. It's decreased by 82.63 points to 15,938.37 points. 0.37 points. The index, however, began at 16,000 plus points during the week before it slumped 500 points, which is the usual magnitude that we talk about in these episodes. So it slumped to 500 points midweek, which is by Wednesday, and that was the result of major producers like Evolution Mining and Northern Star Resources decreasing between 4 to 5%, some maybe even more than that on market open, and then following that up by covering their losses as the trading day resumed. However, developers weren't able to emulate the producers' movements later in the trading day, as developers continued to plummet throughout the trading day, as opposed to major producers like Evolution and Northern Star Resources. As examples, Horizon Minerals plummeted 10%, Bright Star Resources 6%, Barton Gold 4%, with a 7% drop on market open. And despite this, the ASX Gold Stocks Valuation Index developed by Gold Hub Australia continues to stay in the overbought range. Now, we're talking corrections of 7 to 10% or 6 to 10% among developers, which is not managed to recover unlike our major gold producers. And we've seen the major gold producers correct in valuations significantly on select days during the trading week, despite the fact that they managed to recover their losses. How far more do you think these corrections need to go for the ASX Gold Stocks Valuation Index to come back to the fair valuation range?
Well, this one is a tough one, isn't it? Because on one hand, I'm saying that there's value coming out of a selection of gold stocks, but on the other hand, the gold stocks valuation index is showing the ASX gold index in general is overvalued. What's worth noting is that the ASX gold index is trading at this level because relative to the price of gold and the gold to oil ratio, it's possible that the previous periods going back to 2010 till now, we haven't seen such accommodative conditions for gold producers. It is worth noting, even though these gold producers are trading at overvalued territory, their operating margins are they haven't seen such levels of operating margins as good as we've had for a long time. And there is also a possibility, I could argue, that because of how fiat currencies have become much less valuable over these last 2 to 4 years compared to the last 15, that might have also contributed to the ASX gold index trading at this level relative to gold and the gold to oil ratio. Now, gold and the ASX gold index is trading at levels to reflect how worthless the underlying currencies are. Whereas the gold to oil ratio, which is also part of the equation for the gold stock valuation index, that is a relative value of gold and oil. So the inflation effect is cancelled out. So there's a possibility that my overvalued, our index showing that it's overvalued, that the overvalued definition might be on a conservative end. And that's why we do see some investors who would probably consider me as being a little too conservative, taking profits a little too early. For that reason, it could continue to trade at these levels. Now, what would it take to go back to take the ASX gold index back down to fair value territory? I would say that if the ASX gold index pulls back by another 15-20%, notwithstanding any further moves for gold and the gold to oil ratio, or secondly, if gold rises by another 10-15%, while the ASX gold index doesn't also move in that direction. That's also possible. So that's why we take a cautious approach in what we do right now.
Right. Thank you so much for that, Mr. Brian. And I think we've got our viewers to have quite a lot of information to take in terms of the current valuation levels of the ASX All Ordinaries Gold Index, where value lies or where doesn't for our gold producers and developers at the moment, especially considering the recent corrections in mind. And what does the recent private data mean in terms of a rate cut in December? To what extent are we expecting it in comparison to the market, and what can that mean for gold? So we've covered quite a lot in these first 20 minutes, and thank you so much everyone for watching so far. And we now head to our members only section, which if you want to continue watching, you only have to go to the Gold Hub Australia website and sign up for a free membership, which only takes 5 minutes of your time. And I promise you, this is something that you would want to watch, because we do a deep dive into a company every single week where we believe value exists. And we also tell our story about developers, explorers, and producers who we think have got some hidden value in them. So in order to supercharge your precious metals and mining equities investing journey, we recommend that you sign up for a membership for free at Gold Hub Australia. It takes only 5 minutes, and continue to watch the members section with us. So thank you so much everyone for tuning in.